Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Bertha Coombs, in today for Bob Pisani, who's celebrating his birthday. The major averages coming under serious pressure today as coronavirus fears flare up across the globe, with new confirmed cases surging outside of China, stoking fears of a potential long-term global slowdown. We've seen a flight to safety kicking in, gold at a 7-year high, and utilities hovering near records. So how do you protect your portfolio in the wake of these virus fears? I'm joined today by Dave Nadig. He's a director of research at ETF Database, and Todd Rosenbluth of CFRA Research. Dave, let's start with you. How do I protect myself in a situation like this? I see people going to gold. I see people going to the ultra short ETFs.
Sure. Yeah, so there are really two strategies here. One is to reposition and one is to hedge. So if you're looking to hedge, i.e. find the things that are going to go up when the market continues to go down, gold is obviously a good bet there. GLD is the one everybody knows. Right. There's some cheaper options out there, whether it's SGOL or BAR, both at around 17 basis points. That's a classic play here. I think it's more interesting, though, to think about other ways of staying in the market, to stay invested. And that can mean something as simple as looking at sectors of the market that may be a little immune to an ongoing concern about supply lines and all of that. I like the communications sector here. XLC is the spider tracking that. It's down quite a bit today.
Well, Facebook today moving into correction territory.
Exactly. So it's taken a big hit from Facebook. Google and Facebook together represent about 40% of the fund, so it's very concentrated. But you're also picking up Disney and Netflix and names that I think will be much more immune to a protracted downturn.
I'm sorry for jumping in.
Yeah,
there's safer ways of doing that at the sector level too, Dave.
Sure.
So there's utilities, XLU, you mentioned earlier, is holding its own. Real estate is another way of doing that. Or lower volatility oriented ETFs. So SPLV and USMV are two of the flagship products that are out there from Invesco and iShares, and they're more defensive, so you'll have heavier weightings in those more stable sectors. You'll still have some exposure to some of the more cyclical ones, so you can be in the market, as Dave mentioned earlier, but protect more of the downside as opposed to shifting to fixed income or shifting to ultra short with like a MINT product.
Are you guys not tempted here to get in? And I mean, you're getting in at a discount now on certainly something like the QQQs or the diamonds.
I think the question here is what shoes are going to drop that we don't know about yet. So clearly the market is finally reacting. I think a lot of us have been expecting this for a while. I think we got a little bit of Pollyanna out of earnings calls. We did not get a lot of talking down the first quarter, which I expected.
But they also didn't really know.
Right, that's my point. Is we don't
it was really
know,
early.
Right, we don't really know. I think I would not necessarily be looking at this as the opportunity to start buying high-flying tech stocks again, just because they're down a couple percent. Remember, these are the prices we just saw a couple weeks ago.
Right.
It may feel like a big correction right now, but really it's just a 2-week Groundhog Day.
And it's likely that there's going to be more selling, not for a prolonged period of time, but the market sells off this much. We'll maybe see a bounce back tomorrow as some rationalization comes in, but the market's likely to be choppy until we get greater clarity, as Dave talked about. Fourth quarter results were actually stronger than many people expected, but numbers were not part of this. We didn't expect this from a global perspective.
Would you be willing to short some of these major ETFs, or are you worried about, suddenly getting eaten alive in terms of a squeeze?
Well, certainly being short right now is be pure speculation. So if you're a long-term investor and you're using ETFs for asset allocation, you should have nothing to do with shorting. That's a tactical strategy. Obviously, in retrospect, the time to short was yesterday, not today. So I'm always a little reluctant. Yeah, I'm a little reluctant to either try to catch the falling knife and just catch the bottom of something, thinking you're going to get that timing right, or to believe that this is now, say, a 10-day downturn where there's a guaranteed win on the short. Both of those would be very speculative plays.